Reserve Bank of India on February 21st has decided to go on for a massive $10 billion rupee swap agreement. Now this comes at a juncture where RBI wants to inject more liquidity into the banking system of our country, and more rupee liquidity to be specific. Now just last month only, RBI had done a dollar-rupee swap to the tune of $5 billion. And now again this month, whereas February 2025, RBI is again planning to do a massive $10 billion rupee swap, and that too for long term, that is 3 years. Now the main aim of central bank's initiative is to provide a durable solution to long-term liquidity requirements for our country, and also to stabilize the value of rupee and bolstering the nation's foreign policy kitty or foreign exchange kitty. This will help India in covering the liquidity crunch which India has seen as of January 2025, which is the worst liquidity crunch India has seen in the last 15 years. So this currency swap agreement, where RBI would be buying dollars and giving rupees to the banks instead, would help in solving this long-run liquidity crunch for our country. Now what this liquidity crunch is all about, what this currency swap agreement is all about, and what are its implications, advantages and disadvantages, we'll be trying to understand in this particular session. Hello, my name is Preetpal Singh and you are watching Perspective. Now let's get things very straight. Indian banking system has been suffering with a liquidity deficit, that is a liquidity crunch, in more than a decade in January 2025. It's worst in the last 15 years. The liquidity deficit of Indian banking sector has peaked to the tune of 3.15 lakh crores, which is very humongous, very huge. And in the preceding month, tax outflows, GST payments and RBI's foreign exchange interventions to stabilize the rupee in the international market, because of that, it has severely impacted the cash flows outflow of the cash in the banking system of the country. And this deficit has increased the dependence of banks on market borrowings, which is definitely bad for the country. And thereby, it has been keeping interbank transfer rates, that is interbank call money rates, rate at which the banks lend to each other, it has led to these bank rates consistently being more than the policy repo rate of 6.5 in our country. Definitely the policy repo rate has gone down from 6.5 to 6.25%, but the interbank call money rate, that is the rate at which banks lend each other, it has been significantly more than the repo rate of the country. This is what you should be knowing. And to ensure this, how is RBI solving the situation? RBI is doing a massive $10 billion rupee buy-sell swap arrangement. Again, I'm repeating, $10 billion rupee buy-sell swap agreement, or I shall say buy-sell swap auction. Now it aims to address the persistent liquidity crunch of the banking system of the country. But what is this swap agreement? What is this buy-sell and sell-buy swap agreement? And what is the overall dollar-rupee swap agreement all about? We'll be trying to understand in a bit. But before that, you should be knowing a very important thing. In the last 1 to 2 months, RBI has taken several drastic measures. RBI, or I should say Monetary Policy Committee, has taken several drastic measures to boost liquidity in the financial and banking sector of our country. One step which was taken in the bi-monthly Monetary Policy Committee meeting was the reduction of CRR. Reduction of CRR, that is cash reserve ratio, from 4.5 to 4%. That is one decision. We have already made a detailed video on that. You can watch it for your perusal. Second major decision was the reduction of repo rate. That is reduction of repo rate from 6.5 to 6.25%. That is another major decision which was taken by the RBI. And all these are under the part of its monetary policy tools. That is the monetary policy tools which are utilized by the RBI or Monetary Policy Committee, so to say. And now this comes the third decision, major decision, where a dollar rupee, $10 billion rupee buy-sell arrangement or buy-sell auction is to be done by the RBI by the end of February 2025. Now this 3-year foreign exchange swap, it aims to bring around 86,000 crores into the banking system of our country, solving the liquidity deficit of 1.7 lakh crores in the financial sector of our country. Now let us understand what are these foreign exchange swap agreements. See, swap is a very simple term, means exchange. That means dollar and rupee swap means dollar is exchanged for rupee. That is what you mean by swap. So what is this foreign exchange swap agreement? And what happens in this and why RBI is doing it, that is now what we'll understand. See these foreign exchange swap auctions. These are the tools used by RBI to manage liquidity and stabilize foreign exchange markets and financial markets. Now, what happens is RBI, in order to inject liquidity in the banking system, will tell the banks either two things. Either it will be a buy-sell swap, or either it will be a sell or buy swap. Now, these two are very different. In buy-sell swap, what RBI would be doing is RBI will buy dollars from the banks right now. So RBI will tell the financial intermediaries, that is the major banks of the country, that please sell the dollars which you have with yourself. So RBI will buy the dollars from the banks and then sell the dollar to the banks at a later date. This is what involves liquidity injection. So when RBI buys the dollar right now, RBI will give rupees to the banks while buying dollars. So this will give more dollars to the RBI and rupees to the banks. And after 3 years, the banks would be repurchasing the dollars from the RBI. That is what buy-sell agreement involves. So basically, in simple term, it means that RBI buys US dollars from banks in exchange for rupees. And this is what we call as first leg, that is first step. And also it agrees to sell them back, that is to sell the dollars back at a predetermined future date alongside a premium. So when now it will be sold to the banks again, it will be sold at a premium which will help the banks, which will be a profit for the banks. And this is what we call as a reverse leg. So first step is the first leg, that is first step. Second step, after 3 years, what will be done? When the banks again repurchase the dollar from the RBI, that is what we call as reverse leg. And that happens at a premium. So now let's discuss this in even more detail. In the first leg, what will be happening? That the participating bank, it will sell US dollars to the RBI at FBIL reference rate. Now, what is this FBIL reference rate? It stands for Financial Benchmark Indian Private Limited Benchmark Rate, reference rate. At a particular rate, the banks will sell dollars to RBI initially. That is the first leg. And also will receive equivalent rupee liquidity in the market. So it will solve the liquidity crunch of rupees. That is one thing it is doing. Plus it is giving dollars to whom? Dollars to the RBI. And now in the second phase, that is in reverse leg. That is after 3 years, because this is a 3-year arrangement. After 3 years, the banks who have earlier sold the dollars to the RBI, now the banks will repurchase the dollars from RBI by returning rupee funds along with an agreed swap premium. And this will complete the whole swap arrangement in full process. And this strategic move by the RBI, it will enhance rupee liquidity in the banking sector. It will stabilize the rupee, and it will also maintain exchange rate stability to an extent for rupee in comparison to dollars. Now, this is the first type of agreement which I'm talking about, buy-sell swap agreement, which RBI is currently doing. So the current agreement of $10 billion rupee swap agreement, it is a buy-sell swap agreement. So what RBI would be doing currently, it would be purchasing around $10 billion from the banks and would be giving them rupees. And at a later rate, after 3 years, the banks can repurchase the dollars from the RBI, again at a predetermined price and at a premium. We call it as reserve premium. So this is what is currently happening. That is buy-sell arrangement, or buy-sell auction we call it. There is second arrangement, sell-buy auction. Now in sell-buy auction, opposite happens. RBI, rather than buying dollars, RBI sells dollars to the banks right now and buys them back at a later stage. Now this is done for what? This is done for liquidity absorption of rupees. Now, for example, RBI right now tells the commercial banks, tell the big banks which are eligible, financial intermediaries which are eligible for these auctions, RBI tells them that I want to absorb rupee liquidity from you, so I will sell dollars to you now. And I will purchase the dollar back after 3 years from you. This will mean that the rupee from the banks would be coming to the RBI, and the dollars with the RBI would be going to the banks, while RBI is selling the dollars to the banks. This will help in liquidity absorption. But in our country right now, there is a liquidity deficit, a massive liquidity deficit. So what is required is not liquidity absorption, but liquidity injection. And liquidity injection would happen through a buy-sell agreement, where RBI would be buying dollars from the banks and would be selling the dollars to the banks at a later stage after 3 years tenure. That is what your currency swap agreement means, and that is how it helps. One singular role is to help in a liquidity crunch situation and liquidity deficit situation. Now you might ask a question that how does this actually work? So there are certain processes for it. First process is definitely the auction process, where the banks or the financial intermediaries who are eligible for it, they bid in the swap auction. And they say they bid by quoting the swap rate, that is forward premium, and the lowest premium bid is accepted first. As what we know in the government securities as well, the lowest bid is accepted first by the RBI. That is the auction procedure. And after that, it starts with the liquidity injection, where the banks, they sell the dollars to the RBI at the prevailing exchange rate. They sell to the RBI. The RBI provides rupees in exchange to the dollars. It boosts the liquidity in the banking system of the country. That is the second stage. And third stage is the reverse swap after 3 years. After 3 years, what will happen? That is around March 8th, 2028, what will happen? The swap will be reversed. Now, RBI would be returning the US dollars to the banks and absorb the equivalent amount of rupees. So it is right. Now, for short-term liquidity crunch, this solution is feasible for the next 3 years. And this allows RBI to control liquidity, to have a control over the liquidity over a longer period, which we call as 3 years, without permanently altering the foreign exchange reserves of our country. And this is again a very crucial step taken by Reserve Bank of India. Now you might ask a question that what is the actual need of these swap auctions? First need, as you already know, for liquidity crunch. So for liquidity management, these swap agreements are required. Second, it is required for exchange rate stabilization. That means exchange rate stabilization of rupee as compared to the dollars, because it reduces the volatility of rupee in comparison to dollar due to excess liquidity which we have. That is the second reason. And third reason is it helps in foreign exchange reserves management. Now it enhances the efficient utilization of foreign exchange reserves in our country, which is why it is helpful for foreign exchange management. That is the third reason. And the fourth reason is that it indirectly influences, manages inflation level and interest rate control in our country. So because it is influencing what? It is directly influencing the liquidity of the market and liquidity of the banking sector. Liquidity of the banking sector influences the inflation levels, and inflation levels of a country definitely impacts the interest rates of the country. So by managing liquidity, it helps in balancing interest rates, it helps in balancing inflation rates as well, which is why these swap arrangements, swap auctions by the RBI are very much needed. And the same points becomes the advantages as well. That is, it enhances liquidity, it improves the exchange rate system, makes it more efficient. It provides sustainable cash flows for the banks, which again helps the banks to give more and more loans. And also, it prevents excess volatility in the markets, especially the foreign exchange market, because RBI is in a position to buy and sell dollars any point of time which they like, which is very good in order to ensure that exchange rate volatility is reduced to the minimum. But the question is, what are some challenges, probable potential challenges, which it might bring on the table as well? The first very big challenge is in the impact on foreign exchange reserves. That what is the impact of this swap agreements, Forex swap agreements on foreign exchange reserves of our country? So large scale swaps to the tune of $10 billion, it in a way reduces the foreign exchange reserves of the country. So it impacts the foreign exchange reserves definitely. And another reason is the dependence on external factors. So the effectiveness of swap agreement would also depend on a lot of external factors as well, not just internal factors. So it will depend on the global market conditions, it will depend on the capital flows, inflow and outflow of the country, and also interest rate differentials between different countries. So it is not just that India's swap agreement would be successful just on the basis of India's internal condition. External conditions also matter in swap agreement. And if not executed strategically, it may lead to uncertain, unintended currency speculation, which is bad for the economy and which might lead to uncertainty in the market, which is again bad and which is again worrisome. And the biggest challenge is that it is a temporary fix. Because after 3 years right now, RBI is purchasing dollars. After 3 years, RBI has to sell the dollars. So again, the situation would be balanced. So this only solves the problem. This RBI swap agreement, buy-sell swap agreement, solves the problem only for the next 3 years. So it's a temporary fix. It's not a long-term fix. And it's a measure which can help the economy temporarily, but over a long period of time, we need to have certain measures in place to solve this liquidity crunch and to ensure that liquidity crunch in our society, in our country, in our banking system never takes place. So it's a temporary fix. That is one very big challenge. And to ensure that we have enhanced liquidity, structural reforms are required and are need of the hour. Until unless structural reforms are done, these liquidity swap agreements might help on the sidelines, but won't change the picture, the actual picture of the banking system and its liquidity. See, if you see it objectively, Reserve Bank of India has induced around 3.6 lakh crores into the banking system of the country, into the durable liquidity of the banking system of our country in the last 5 weeks. Whether it be through debt purchases, whether it be through foreign exchange swaps, or it is due to longer duration repos. But one thing is very sure, that all these arrangements taken forward by the RBI, these are temporary measures, temporary fixtures. What is required in the banking sector is structural reforms to ensure that liquidity crunch, whatever lakh crores is there in the country right now and in the past, in the future as well, that can be curtailed, and it is made, the loans are made available for our country at large. Because whenever a developing nation is growing, and we are growing at a rate of 6 to 7% on an average, and when 6 to 7% on an average, we have to take it to around 10% on an average to reach a $5 trillion economy in the future and $10 trillion economy in the near future as well. In order to ensure this, liquidity deficit problem needs to be solved by the banking sector of our country. And here, a very proactive role by RBI, Reserve Bank of our country, in introducing structural measures is very much required. I hope you gained a new perspective from the session. Do let me know what are your views surrounding this liquidity crunch and measures taken by RBI to ensure that this liquidity crunch is solved. Thank you very much and have a very beautiful day.